Warren Buffett suggests that investors put 90% of their money in an S&P 500 fund, keeping the rest in short-term government bonds. This is a great strategy for many investors who would prefer to keep things simple, investing on autopilot without having to analyze their portfolio every day. The downside to this method is that you're limited to investing in just large U.S. companies. It's possible for you to increase your exposure to other markets while still keeping your portfolio simple by investing in a selection of Vanguard funds. There are many different ETF or exchange-traded fund and index fund companies, but Vanguard has been the choice for many investors. Enabling low-cost investing for many decades, the fees charged are extremely competitive and the investment firm is well established to provide security for your retirement savings. The company was founded in 1975 by the pioneer of index funds himself, John Bogle. Other companies offer very similar funds, and you are free to choose the company of your choice, but to keep things simple, we'll just focus on Vanguard funds. The first and most popular fund is VOO, which is Vanguard's S&P 500 ETF. The S&P 500 is a basket of 500 of the largest U.S. companies. This index is commonly thought of as a good indicator of how the overall market is performing. When you hear people say, the market, this is usually what they're referring to. Some of the criteria the stock must meet in order for a company to be selected for this index are that it must be a U.S. company, the market cap must be $5.3 billion or more, the company must report positive earnings for the past 4 quarters, and the stock must be trading at a reasonable share price. These are some of the reasons why Warren Buffett suggests the fund to most investors. A few names included in the fund are Apple, Microsoft, Exxon, and Johnson & Johnson. The fund's expense ratio is just 0.03%, making it overall one of the best funds of which to invest. VYM is a high dividend yield ETF primarily focused on investing in companies with consistent dividend payouts or payment rewarded to shareholders. It trades stocks with high dividend yields with respectively low risk. It's composed of 425 primarily large U.S. companies. Consumer goods, financial services, and healthcare are the 3 largest sectors, so growth tends to be slightly slower than the overall market. This is a great fund for retirees who are able to live off their dividend payments, not requiring them to sell their investments for income. Some of the largest holdings include Verizon, Chevron, and AT&T. With an expense ratio of 0.06%, it's slightly more expensive than the S&P 500 ETF. Vanguard Total Stock Market ETF, or VTI, is a fund that aims to track the overall stock market instead of only owning large companies like the S&P 500 does. Owning shares of over 3,600 different companies, the fund invests in stocks that are widely diversified from small to large companies. VTI invests in many stocks, allowing it to capture returns from a wide range of companies in terms of size, instead of only receiving returns from the country's largest players. Alphabet, Exxon, Apple, and JP Morgan Chase are included in the top 10 holdings. The 3 largest sectors are technology, financial, and healthcare. The expense ratio is very low at just 0.04% annually. Vanguard Growth ETF, or VUG, is a fund primarily focused on investing in companies that tend to increase in capital, or grow. Holding around 300 different stocks, the fund carries large-cap companies like Apple, Amazon, Facebook, and Google. While sharing in the profits of big growth companies like those mentioned, they tend to be more volatile and subject to market fluctuations, making it more desirable for younger investors with higher risk tolerance. With technology being its single largest sector, followed by consumer services and industrials, this is a well-balanced fund for those willing to take on slightly higher risk. An expense ratio of 0.04% makes it comparable to other Vanguard funds and very inexpensive. VT, the Vanguard Total World Stock Fund, is a great way to gain exposure to global stocks comprised of U.S. and foreign companies. The fund owns shares of over 8,000 different companies, ranging from micro to large cap, with most of the fund consisting of U.S. stocks and a combination of global markets. Holding companies such as Facebook, Berkshire Hathaway, and Exxon, this fund is a great way for investors to add shares of global companies to their portfolios to avoid being concentrated in just the U.S. With an expense ratio of 0.09%, the fund is slightly more expensive than the others mentioned, but still very reasonable. These Vanguard funds are just a sample of what the company has to offer, but a great combination of funds to add to your portfolio in order to be well diversified. The cheapest fund mentioned charges $300 on a $1 million investment, and the most expensive charges $900 on a $1 million investment, which makes them very affordable, especially when compared to an actively managed mutual fund. If you'd like to see more information about these funds or other Vanguard funds, a lot can be learned on the Vanguard website. The Vanguard ETFs can be traded like stocks in a brokerage account, and they can help establish a well-balanced portfolio for your future.